You ever notice how some opportunities sound almost too clean, like everything has been simplified just enough to feel safe? You're told you can now own a fraction of real estate across the world, earn income from assets you could never afford before, get access to investments that used to be reserved for institutions. It feels like the system is finally opening up. And for a moment, it feels fair. But there's a quiet question most people don't ask. If access is suddenly easy, if everything is being democratized, then why does it feel like the responsibility is getting heavier? Because sometimes, what looks like opportunity is actually risk, changing hands. And you don't notice it until you're the one holding it. Most people think tokenization is about innovation, new technology, new markets, new ways to grow money. And that's not wrong, but it's incomplete. Because the way it's usually explained makes it sound like a win for everyone. More access, more liquidity, more inclusion. What rarely gets discussed is what's happening underneath. In traditional finance, risk used to sit in very specific places. Banks held it, institutions managed it. Large funds absorbed it. There were layers between you and the uncertainty, not perfect layers, but layers nonetheless. Now those layers are thinning, and in some cases, disappearing. Tokenization doesn't just open doors, it also removes buffers. And when buffers disappear, risk doesn't vanish. It moves. Quietly. Let's slow this down. Imagine a large commercial building. Something expensive. Something stable. In the traditional world, owning a piece of that building isn't simple. You'd need serious capital, connections, and patience. Most people never even consider it. Now enter tokenization. That same building can be divided into thousands of digital tokens. Each token represents a small slice of ownership. Suddenly, anyone can participate. It feels empowering. You can invest with a small amount. You can diversify. You can be part of something bigger. But here's where things shift. When large institutions owned that building, they also carried the complexity. Maintenance risks. Tenant issues. Market downturns. Liquidity constraints. They had teams to manage this, systems to absorb shocks. When that asset becomes tokenized, the exposure gets distributed. And so does the risk. But not always equally. Because while ownership becomes fractional, understanding doesn't always follow. A lot of people buy into these tokens without fully grasping what they actually hold. Not because they're careless, but because the experience feels simple. The interface is clean. The process is fast. The language is optimistic. And psychologically, simplicity lowers our guard. We assume something that's easy to access is also easy to understand. But that's rarely true with financial systems. There's another layer here that's even more subtle. Liquidity. One of the biggest promises of tokenization is that assets become easier to trade. In theory, that's powerful. You're no longer locked into long-term commitments. You can exit when you want. But liquidity isn't just about being able to sell. It's about someone else being willing to buy. And that part is never guaranteed. In traditional markets, institutions often act as stabilizers. They provide depth, they absorb volatility. In tokenized markets, that support isn't always there. So what happens? Prices can move faster. Confidence can shift quicker. And exits can become crowded, all at once. Which means the very thing that feels like freedom can turn into pressure. You think you can leave any time. Until everyone else wants to leave too. And then there's the issue of incentives. This is where things get uncomfortable. Because whenever a system becomes more accessible, you have to ask who benefits the most. Tokenization allows asset owners to unlock liquidity from things that were previously hard to sell. That's great for them. It means they can distribute parts of an asset to a broader market without giving up full control. From a business perspective, it's efficient. But from an investor's perspective, it raises a question. Why is this asset being offered to me now? Is it because it's a great opportunity, or because it's a convenient way to shift exposure? That doesn't mean every tokenized asset is bad, but it does mean the dynamic has changed. In many cases, you're no longer just participating in growth. You're also participating in risk redistribution, and that redistribution is often invisible. It doesn't feel like risk, it feels like access, which is why it's so easy to overlook. At some point, you start to see it differently, not with fear, but with clarity. Tokenization isn't inherently good or bad, it's a tool. And like any tool, it depends on how it's used, and how well you understand it. The real shift happens when you stop asking, is this a good investment? And start asking, where is the risk sitting right now? Because risk doesn't disappear, it relocates. Sometimes it moves from institutions to individuals, from opaque systems to transparent ones that still require interpretation. And once you see that, your behavior changes. You slow down. You question more. You stop confusing accessibility with safety. And you begin to realize something important. Just because something is finally available to you, doesn't mean it was designed with you in mind. That's not cynicism, that's awareness. And awareness doesn't make you hesitant, it makes you precise. So what do you actually do with this? Not in theory, but in real life. You start by adjusting how you approach these opportunities. Instead of focusing on how easy it is to get in, you spend more time understanding what you're stepping into. What exactly does this token represent? What drives its value? What happens if the underlying asset struggles? You don't need to become an expert overnight, but you do need to stay curious, because the gap between simplicity and reality is where most mistakes happen. You also learn to respect liquidity differently. Just because something can be traded, doesn't mean it will be, and that changes how much you're willing to commit. You avoid putting yourself in positions where you need a perfect exit, because markets rarely give you that. There's also a psychological shift that matters more than anything else. You stop chasing access for the sake of access. You don't feel pressured to participate in everything that becomes available. Because not every door that opens is meant to be walked through. Sometimes the smartest decision is to observe, to wait, to understand how something behaves over time, and then decide. Not from urgency, but from clarity. That alone reduces a surprising amount of stress. Because a lot of financial anxiety doesn't come from losing money, it comes from not fully understanding what you're involved in, and trying to keep up anyway. There's a quiet shift happening in the financial world. Things are becoming more accessible, more flexible, more available. And on the surface, that feels like progress. In many ways, it is. But progress isn't just about what you gain. It's also about what gets transferred along the way. Responsibility, complexity, risk, and sometimes those things move faster than our ability to process them. So if you've ever felt that subtle hesitation, that moment where something sounds good, but not entirely clear, that's not weakness. That's awareness trying to catch up. You don't need to have all the answers. You don't need to participate in everything, you just need to stay grounded enough to ask better questions. Because in a world where access is expanding, clarity becomes your real advantage. And that doesn't come from rushing. It comes from paying attention. Over time, slowly, consistently, things start to make more sense, and that's enough. Because when you understand what you're holding, you stop reacting to noise and start making decisions that actually feel like your own. Not perfect decisions, but intentional ones. And those tend to compound in ways that matter far more than speed ever could.